Real estate is one of the most popular investments in Kenya, but isn't as glamorous as most people think. This year I had an interesting chat with a client of mine who really wanted to invest in real estate because it was his dream to be a landlord or maybe to own some property here in Kenya. So we ran the numbers using the property that he was renting at that time, because the owner of that property was actually looking for a person who was willing to buy his property because he was disposing that property. And the first person he approached was actually the client who was renting out that property. So we determined the rental yield of that property, which you only determined by checking the annual rental income. Then you divide that by the market value of that property. And to our surprise, the rental yield of that property was actually 4%. So rental yield is just like the part of the return on investment of a real estate property, because real estate has two return elements. Number one being the rental yield, which is the return on investment, or the cash flow that you are getting from your rental income. And then number two is the appreciation aspect, maybe the annual change in price or market value of the property that you own. So that's one of the problems that most people miss about on real estate. So the rental yields in Kenya on average are between 4 to 6%, but in some prime properties, some prime residential properties, you'll find that the rental yield between 6 to 8%, and then for commercial properties, the average is between 8 to 10%. So if you compare that with other investments, even a simple investment like bonds, you'll find that even bonds do much better, because bonds in low interest rate environments will fetch you between 12 to 14%, but this year in high interest rate environment, we have seen bonds fetching between 16 to 18.6%. So in this video, we're going to be delving deeper into real estate and just caution you on how real estate has performed in Kenya as an investment class, or maybe as an asset class. So we're going to be looking at the bad things about real estate and also the good things about real estate. So do stick with me through this video, and if you like educational videos on money, personal finance and investments, then you can consider subscribing to my channel, as I'll be doing more educational videos that will help you make more intelligent financial decisions. Like I mentioned, real estate investing in Kenya isn't as glamorous as it seems. Yes, we all want to be landlords, but if you just look at the numbers and the features of real estate as an investment in Kenya, you're going to find out that maybe it doesn't rank as high, maybe compared to other asset classes. Other asset classes have an edge over real estate in very many areas. So we're going to be looking at some of these areas. Like I mentioned, I started with one thing, which is the return element. Like I mentioned, real estate has two return elements. Number one being the rental yield, or maybe for someone who is looking for passive cash flow, because most people get into real estate looking for the passive rental income. So because you are sure that maybe your clients are going to be paying rent month on month, then that will boost your passive cash flows. But then remember, like I mentioned, the average rental yields for Kenyan properties is between 4 to 6% for the average property in Kenya. Then for some prime properties in prime locations, you may find the rental yield being between 6 to 8%, and then for commercial real estate, the rental yield can be between 8 to 10%. So these are just average numbers. Of course, we have some outlier properties, but then those are the exceptions, not the rule. So number one, if you're looking for passive cash flow or maybe passive income, rental income isn't the best alternative, because if you compare with other options, like I mentioned, bonds have a return of 12 to 14% on low interest rate environments, and then on high interest rate environments, like you have seen this year, bonds have returned as high as 18.6%, but then on average, like I've mentioned, is between 12 to 14%. Then number two, even money market funds have an average return of, let's say, 7 to 10% in a low interest rate environment. This year in high interest rate environment, we have seen money market funds fetched as high as 18% on the interest on savings. Then number three, even the dividend kings of the NSE, the year on year, there are some companies that have very good dividend yields. If you look at the top 10 dividend paying companies last year, they all had a dividend yield of above 11%. So if you compare that with the rental yield of 4% for our real estate, then it isn't as good as we think it could be. So in terms of a return aspect, the rental yield, most for someone who's looking for passive income, if you want a good alternative for rental income, then the coupons from bonds are better, the dividends from dividend kings of the NSE are better, the income, or maybe the interest earned by money market funds, is even better because of the rates that we have seen. Then number two is what we call the occupancy rates. So if you look at real estate properties, the occupancy rates aren't always 100%. What I mean by occupancy rates is, let's say you have a rental property that has 20 units. So how many out of those 20 units are occupied throughout the year? So if you just do a random check in your neighborhood, just take a walk at night at some properties at night that don't have lights going up, or maybe lights lighting up at night, because that's the easiest way to determine if units in a certain area are occupied or not, and maybe the levels of occupancy, because most people will always be in their homes at night, most on weekdays. So that's maybe the best test to know how an area is faring on in terms of occupancy rates. So if you look at the average property, again, it depends with location, and then it also depends with the type of property that you own, because there's some people, or maybe some properties that are actually outliers compared with the average properties in that area. Hence, they may find it much easier to attract more clients and even retain clients, and they may not have vacant units during the year. But then again, I think it's a problem for all real estate owners because they have to struggle with the occupancy rates. So you have to, in a certain period of the year, or maybe in several periods of the year, you're going to have vacant units, and vacant units mean an earned income. So that means income that you have not earned from some of your units. That means an even lower rental yield, an even lower cash flow earned from your real estate property. The number 3 is that you have to deal with tenant management. So we all know dealing with client and dealing with people is not the easiest thing to do. You have to be very good at dealing with people. So sometimes you can have very different types of clients who don't pay rent on time, clients who run away with their money, so clients who disturb or even damage your property, or even disturb other tenants in your property. So the issue of tenant management, so either you can outsource it, and outsourcing it increases your expenses, which reduces your rental yield on the other end. And then if you do it yourself, then that means you have to spend actually more time managing your property or even managing the investment. But if you compare that investment with other investments like bonds, for example, once you buy a bond, you have forgotten about that investment, and that bond will pay you coupons each and every 6 months with you not even having to remember that you actually own a bond, but you'll just get that surprise line of transaction added to your bank account that you have received a coupon payment from a certain bond. The other part on about real estate is also when you look at the tax element of real estate. So we are going to be comparing the tax effectiveness, because as you grow your wealth, you stop worrying so much about things like inflation rate. You stop worrying so much about the return on investment, because the biggest threat to your income, maybe to your wealth, is actually the tax that you're paying each and every year. Because if you look at our tax rates, more so for the earned income that you're doing from our salaries, the guys who are on the higher end are paying 30 to 32.5% in terms of tax pay. But if you look at investments can always be a good way to run away from taxes, because if you look at the taxes on investments, infrastructure bonds are tax free. We know that dividends are taxed 5%, rental income is taxed at 7.5%. So if you're looking for an investment that doesn't have a lot of tax obligations, then maybe there are other investments that maybe rank higher than real estate. So far we have looked at the rental yields. We have mentioned that maybe the rental yields aren't the best compared with the other return on investments, more so for passive income. If you're looking for cash flow, then instead of pursuing rental income, there are better alternatives. We have looked at the tax implications. We have looked at things like occupancy rates and tenants management, which are some of the disadvantages that real estate has. So other disadvantages for real estate, maybe the other things that make real estate a not so good investment, or maybe not as glamorous as most people think, is that setting up, maybe developing most real estate properties requires expensive loans, because not most Kenyans have the savings that can actually develop a rental property, maybe a real estate property. So you have these two options whenever you're trying to build your wealth. You can either save money month on month and build your portfolio from the way down upwards, or maybe you can take a loan and maybe set up a portfolio and maybe use real estate, for example, as the bigger part of your portfolio, maybe as a starting point for your portfolio. But then again, you have to deal with the expensive loans. Remember, in Kenya, due to the Kenyan government offering high returns on government bonds, commercial banks are lending money to individuals and to businesses at very high rates, because the government is competing with individuals and businesses for money from commercial banks, which is not a very good scenario. So you'll be servicing a very high interest rate loan on your real estate property, maybe at 13, 14, or even 15% on a low interest rate environment. But then remember again, your property is only giving you a rental yield of 6% per annum, even if you completed it as soon as you took your loan. And then again, the capital appreciation element per annum, it's going to vary based on your property, but maybe the average capital appreciation, again, depending with the location. So within Nairobi, if we go with the Haas index, maybe the average appreciation is around 4% or even 5%. So if you add those two up, you're going to be getting a return of 10%, but then you're servicing a loan at 15%. So you're actually losing money in the short term, and it will even take you a longer time before you recoup your investments. Then the other part about real estate, the other bad thing about real estate is that if you look at how rent is hiked with inflation, you'll find that the rent aspect of real estate does not always keep up with the inflation rate. What do I mean by that? If you look at the rental property, if you are renting today, where you have been renting, if you have been renting for the last, let's say 2 or 3 or 5 years, how many times has your landlord hiked the rent of that property that you live in? For most people, most landlords usually hike the rental prices for their properties whenever tenants are moving, or maybe when units are exchanging ownership. So you'll find that maybe for the last 2-3 years, yes, the inflation rate has been going up, but maybe the return from this asset class hasn't been keeping up with the inflation rate, because the landlording the rental income, maybe the demand for rent with the corresponding increase, or maybe the corresponding inflation levels in the country, which should ideally be doing. The last bad thing about real estate is the misconception, or maybe the false belief that most people have, that the price of real estate properties is always going to go up, or maybe property always appreciates in value over time. If you look at the House Index, which is an index that compares the price of properties and land in Nairobi and surrounding areas, you're going to find out for the past 1 year, there are some areas in Nairobi, even within, whereby properties have actually gone down in value. It's always a matter of shifting perspectives, because remember, the prime areas today, or maybe the prime locations in Nairobi today, will not be the prime locations 10 years to come. So dynamics are changing, things are changing, economic times are changing, and now based on this, the forces of supply and demand, because they are the forces that dictate most things in financial markets, even in markets, these things are going to come into play, and the equation can always change. Yes, today this place is a prime area, but let's say in the next 10 years, most people are going to acquire properties in this area. Maybe it's going to become overcrowded. So people will tend to focus on looking at land or maybe property at other areas that will not be overcrowded at that time. So that false belief that prices in a certain prices of land and houses will always go up is usually a misconception, because if you look at the House Index, actually last year, maybe even the last quarter, last year, last 5 years, there are some prices whereby properties are actually going down in prices, and there are places whereby the rental price is actually going down as well over the past few years. But maybe over the long term, yes, over the long term, maybe prices over the long term, by long term I mean maybe 20-30 years, maybe the prices will always go up. But before that, prices are always bound to have a lot of fluctuations. So that's it on the bad side of investing in real estate, like I mentioned. So maybe just to reiterate what I was saying. So number one, real estate requires very super expensive loans to set up. Number two, rental yields aren't as high compared to other cash generating asset classes like bonds, dividends from stocks, and even interest rates from money market funds. Then number three, occupancy rates will not always be 100%. That means we'll have some unearned revenue. Then number four, the client management can give you more headaches compared to other investments that actually don't require you to do anything. You just sit and wait for money to get into your bank account. Then number five, the rental prices don't always keep up with the inflation rate, because rental prices are not always adjusted with the changing inflation rates. Then number six, the tax benefits, maybe the tax implications. Maybe real estate isn't the best positioned to maybe shelter you, maybe to give you that tax relief element, because there may be other tax-free investments like Euro bonds, like infrastructure bonds, even though we are seeing that maybe the government is planning to introduce a 5% withholding tax on infrastructure bond that was actually not approved by parliament. Then the last thing, people always have this misconception that maybe the prices of land or maybe even real estate always goes up in the long term. So that's a misconception. If you look at the House Index, there are properties that actually appreciate in value over a certain period of time. So that's the bad side of real estate. But then again, real estate doesn't only have the negatives, it also has the positives. So let's now look at the positives of investing in real estate. So number one is that it's a good addition for diversification. So if you have maybe bonds in your portfolio, you have stocks, you have crypto, you have all these other asset classes, it can give you something different in your portfolio. And then number two, it is more resilient to shocks in the financial market. So whenever there's a recession, whenever there's maybe low inflation, whenever there's maybe a collapse in the stock market, the real estate sector is always very resilient, because most of our country like Kenya, whereby the population is growing, demand for real estate is growing, so it can always absorb those shocks over time. Then number three, Kenya being a growing economy, maybe whereby the population is growing, like I mentioned, we are going to see more uptake for real estate, more demand for real estate, because more people are coming to the urban areas, urbanization, more people are moving to towns, and we have a very huge young population. People are projecting a very huge population growth, more so in Kenya and Africa, up to the year 2100, whereby maybe the high population growth is going to move from Asia, from India and China to Africa, and more so sub-Saharan Africa. So with that, you can maybe betting in the real estate industry, also in Kenya, with those aspects of urbanization and population growth, it can actually be a good long-term bet, because you're going to see more demand for real estate in Kenya. So I think with all that, and maybe the last point being that real estate gives you a good element of both capital appreciation and also passive cash flow, being one of the few investments that can actually give you both those in one. So yes, you can earn cash flow and still you can have to grow your wealth, maybe multiply your capital in the same investments as real estate. So I think with that, it gives you some good aspects also to add in your portfolio. So for me, my last words about real estate estate will be, it's a good investment, but for me, I would like to maybe start with other investments, that can give you more returns on your money in terms of cash flow, maybe in terms of capital growth. So if you're wondering how maybe an ideal portfolio would look like, I'm going to link a video here with that I had done about how you can create a portfolio and some of the things that you should be considering. So that's number one. Then number two, I will use real estate for diversification. So maybe it will be one of the last investments that maybe I will add to my portfolio rather than it being my first. But then again, for me, maybe I can say that maybe real estate still doesn't make a lot of sense for me adding it to my portfolio, because I can enjoy the benefits that real estate has in other asset classes, and I can still maybe afford to miss out on real estate in my portfolio. So that's it on real estate in Kenya. So let me hear your thoughts about real estate in Kenya. Do you think it's a hyped investment, or maybe something that most people think it's a good investment but don't look at the numbers? So let me get your views on real estate investing in Kenya. How has the journey been for you? If you're buying properties, there are a lot of real estate developers here selling properties in very good areas. Are you buying those houses off plan? Do you prefer maybe to build your own rental house? Are you taking loans to invest in this real estate property? And maybe how has it compared with other investments? And if you're still big on real estate, maybe you can give us the reasons that you're still a big believer in real estate. So that's it from me for this video. Like I mentioned, if you are interested in more topics on personal finance, investing, and financial matters, do consider subscribing to my channel, as I'm going to be releasing more videos, more educational videos that can help you make more smart and better informed financial decisions. So that's it from me for this episode. See you in the next one. Bye bye.